All right, hello and welcome. My name is Kjetil Storsletten. I am the director of the Heller-Hurwicz Economic Institute here at University of Minnesota. The Heller-Hurwicz Economic Institute has the mission of building a bridge between leading-edge economic research that happens here on campus and the business leaders, policymakers, community members, and government officials who can benefit from that research. We fulfill that mission through events like this webinar, through other communications, including the office hours podcast, etc. And we're excited to welcome you to our webinar, which promises to be a very engaging conversation. We're joined by economists, policymakers, journalists, students, and others interested in better understanding and engaging with the major economic issues of the day. Thank you all for being here. And now, over to Chris Farrell.
All right. Well, thank you very much. And I'm really looking forward to this conversation. And I just want to say, if you have questions, put your questions online and we'll get to as many as we can. But we also have set aside some time at the end of this session for your questions. And of course, the timing for this conversation is just terrific. The Federal Open Market Committee is meeting this week to decide on monetary policy. President Trump has said that he's picked his replacement for Fed Chair Jerome Powell. And Trump has also made it clear that whoever gets the nod, he wants lower interest rates from the central bank. So there's lots to talk about in terms of thinking about independence, accountability, and what do these terms really mean? And we have a great panel to discuss questions like these. And in the interest of time, I'm just going to do the bare bones introductions. Gary Stern is former president of the Federal Reserve Bank of Minneapolis. Art Rolnick is the former director of research at the Federal Reserve Bank of Minneapolis. And John Cochrane is a senior fellow at the Hoover Institution. And before that, he had a long career at the University of Chicago. So to launch this conversation, Art, I want to give us a little bit of background on this hybrid institution known as the Fed.
Well, thank you, Chris. I'm going to take the position that the Federal Reserve System has served our economy well, and the independence to carry out its mission has been critical to its success. So let's start with a basic question. Why do we even need a central bank? Well, the Federal Reserve was created by Congress in 1913 to be a lender of last resort. That is, a central bank that during banking panics is to freely lend to fiscally sound commercial banks. Why did they see a need for a bank like this? Well, history is very telling. Post-World War, post-Civil War, I should say, in virtually every decade, there was a major banking panic, and they were often followed by severe recessions as people wanted their money out of banks because they didn't know whether it was a good bank, a bad bank, could they get their deposits out? And so as banks started to call in their loans, needless to say, it was economic chaos and recessions followed. Okay, so they created a bank to be a lender of last resort, but why a federal banking system containing 12 district banks and 7 members of what was known as the Board of Governors? Why didn't they just do one government bank? Well, it was basically not surprising to limit the power of this very powerful bank. They wanted to limit the power so there wasn't one person or one bank that would have control over the decisions. It was kind of based on a lot of concern way back in 1828 when the Second Bank of the United States, which was a government bank run by a man by the name of Nicholas Biddle, was accused of using bank funds to help finance the campaign of John Quincy Adams against Andrew Jackson. So it's not surprising a number of years later, Jackson vetoes that bank charter, and we really didn't have a government bank, a central bank, until 1913. All right, 1913, you could ask the question, why was there a need for Congress to authorize the Federal Reserve to manage the country's money supply? 1913, the U.S. was on a gold standard. Gold, amount of money in Fort Knox or whatever, determined the amount of money supply. Well, 20 years later, FDR takes us off the gold standard during the beginning of the Great Recession, thinking there was a need to do a better job with managing the economy through managing the money supply. So, and not shortly after that, they created the Federal Open Market Committee. This is the committee that's made up of the 7 governors and the 12 district bank presidents. All the 7 governors at these meetings have a vote. 5 of the presidents have a vote that rotates. That's the committee that you hear about today that decides how to influence the economy through issuing money, controlling interest rates, etc. So again, in 1913, there was no need to have this amount of control, but now the Fed has the power of lender of last resort and controlling the money supply. So finally, why did Congress create an independent central bank? And again, history tells us a lot about this because politically, it's often easier for a country to print money to finance government rather than to tax or borrow. There's extremes example of this, the hyperinflations of 4 countries after World War I. We're talking about Germany, Hungary, Poland, and Austria. These are countries that had severe damage to their economies, to their countries after World War I, hard to borrow or to tax. So they used the printing press, and out of that came hyperinflations. It was just a disaster for these economies. And we have more recent examples, Argentina and some other countries that have tended to use the printing press a lot, which creates a lot of ongoing inflation and very disruptive to economies. So what does independence means here? In this country, it means neither the President of the United States nor the Secretary of Treasury can order the Fed to inject more money into the economy in order to lower interest rates. That decision is made by the Federal Open Market Committee, as most of the country knows, because the media covers it. Every 6 weeks, they have to make a decision. They meet in Washington to make that decision based on the best economic data and economic theory that they have. And so the Fed is solely responsible for managing the money supply. But I'm going to argue it's always accountable to Congress. The president appoints the governors with Congress's approval. Congress requires the Fed to testify at least twice a year on their mission. And let me just point out their mission, or what they're required to do, was explicitly established in 1978 under what's known as the Humphrey-Hawkins bill, to keep inflation low and employment high. Not only that, internally, and this most people don't understand, it's a complicated system. It's the local boards of directors that appoint the bank presidents, and each bank president is accountable to their directors. So let me conclude with this basic discussion. Despite all this complexity, the Federal Reserve System, I'm going to argue, has worked. Post-World War II, U.S. economy has formed better than any advanced economy in the world with relatively low inflation. U.S. economy grew at an average real rate of over 3% annually. And since the end of World War II, with the Fed keeping inflation on average well below 4%. So one might ask, as we're doing at this webinar, what's broken? I'll turn it over to you, Chris, and the other panelists. Thank you.
Okay. So Gary, I know you want to make some remarks, but I do also want to add, if you could also tell us, what's an FOMC meeting like, Federal Open Market Committee meeting? Because you sat in on a lot of those. So I just wonder if you could also tell us, since they're meeting
Yes,
this
I'll
week.
I'll be happy to describe the meeting, and I'll make a few comments in following up on what Art said. So the Open Market Committee meeting typically starts on say Tuesday afternoon. And the first part of the meeting is a very broad review of current economic conditions in the US and globally, and a discussion of the economic outlook, principally in the US, but to some extent globally as well. The staff does the initial presentations, but all participants, that is, members of the Board of Governors and Reserve Bank presidents, can comment on the domestic economic outlook. They'll report on economic developments within their own districts, and they'll also, if they choose to, give their view on how the outlook looks to them and where the risks lie. And that's the bulk of the first part of the meeting. The second part of the meeting, which is the morning of the next day, is a discussion of policy options and the rationale for those options. Should interest rates be maintained at current levels, raised or lowered, What's the argument underpinning those alternatives? Where do the risks lie? What is the outlook? What is our best guess of how the economy is going to perform going down the road? And that's very important because forecasting the U.S. economy is generally a challenging job. It's not that you're going to be widely off most of the time. You're going to probably get a lot of it right. But it's at turning points when economic growth turns to recessions or recessions turn to growth. Those circumstances are hard to call. At the end of the meeting, there's a vote, and it's majority rules. So if there are 12 voting members, there'll be a vote on the decision to maintain interest rates, raise them or lower them. And as I said, it's majority rules. It's a very serious, evidence-based discussion. In my experience, while individual members may once in a while inject some political considerations, there's never been a decision that I observed that was determined by political matters. And I attended virtually every meeting from 1982 till the middle of 2009. So these are people who take their jobs very seriously, and are very objective and concerned about maintaining the quality of the Fed's decision-making process, in my experience. That doesn't mean the Fed always gets it right. And obviously, to the extent that we can find ways to improve the way the system works, it's important that we do that. But if we're going to try to fix it, let's make sure we understand what's broken first. And as I think Art described rather nicely, it's a complex system of checks and balances by design. And I think there's a lot of virtue just saying that. I think that demonstrates the virtue in it. I would also argue, and not everybody would agree with me, that ultimately the Federal Reserve cannot impose policies on the country for which there is not support, or at least tolerance. And that's why Federal Reserve officials testify before Congress, frequently give speeches. I think one of Paul Volcker's great accomplishments back in the early 1980s, when interest rates went very high in order to curb double-digit inflation and set the economy on a much more favorable path, Paul did a wonderful job of at least building tolerance for some very serious economic medicine. I would contrast that with the budget situation. I think there's a fairly widespread consensus today that the path of the federal budget is unsustainable because expenditures are running well above revenues, and the expenditures, putting aside interest on the debt, are largely tied up in entitlement programs, Medicare, Medicaid, and Social Security. Politically, it's very tough to reduce those entitlement programs relative to the path they're on. The other option, raising taxes, is equally tough to do politically. And so while the problem is well recognized, and people in various administrations and in Congress have identified it, they've also, those that are honest, have basically said, we'll leave that to the next administration because that's a painful thing for us to pursue. You don't have that kind of problem in the Federal Reserve for the reasons that have already been described. Thanks.
Thank you. And John, I know you have some remarks, but I also want to throw in there one of the questions that's come in that you can, maybe address it toward the end, depending on what you want to say. But it's kind of gets to the heart of what our conversation right now. Given the current political climate, do you think the Fed's independence is more at risk today than in previous cycles?
Yes.
Now you can elaborate.
But yeah, let me make some comments that'll frame that. I'm obviously here to be the Fed critic, it looks like. But before I jump into that, I do want to say the Fed is as Art and Gary said, remarkably well structured. Congress used to be able to put things together nicely, and the Fed is really put together nicely. One thing I'd emphasize, it's a consultative institution. This whole Federal Reserve, regional feds, and the meeting structure and who the FOMC members are is designed to bring in information and also to form consensus. The reason that Gary and Art talk to local businessmen and women and local bankers is partly to know what's going on, but also partly that everybody's on board with that. That's a very important thing for a powerful agency like this. And also, even when I'm critical, the Fed is full of good people. I know a lot of the FOMC members. Everyone I've met is a dedicated, honest public servant, relatively apolitical. Politics in some sense guides our sense of what's best for the country. But there's no story of bad people here that I can make. And the Fed is, I'm going to criticize the Fed a little bit, but all the rest of the federal government is much worse. It's probably the most competent agency that I know in the federal government. Okay, so much for the nice stuff. Why are we here? Why are we even talking about it? Obviously, President Trump wants to fire some Fed people and put some others in, and he wants lower interest rates, and he wants them now. Now, that's a transitory issue. I think there are more permanent issues, and I'm going to think about those as well. The Fed there are problems, or there at least are things that we might want to reconsider. The Fed has really expanded what it does in the last 20 years since the financial crisis. One of the ways you see this is in the financial regulatory footprint. We've had two big bailouts where the Fed handed out a lot of money to a lot of people, bailed out money market funds twice. In 2020, I won't give you the litany of complaints. Chair Powell issued a Mario Draghi-worthy promise that corporate bond prices will not fall. Now, it's not obvious to me how secondary market corporate bond prices falling are something that is in the Fed's remit, but that's what it's doing. Financial crisis is not somebody somewhere might lose money on some unwise investment. We seem to be sort of heading that way. Fed has not only expanded what it does tremendously, it's changed its tools in ways I think are great. I think the move, Art said the Fed controls the money supply. It doesn't do that anymore. The money supply is nearly infinite. The Fed sets interest rates. Now, I think that's great, but other people don't like that. Certainly is worthy of discussion. And we are on the heels of, I'd say, three big failures. One is the need in 2020 to repeat a lot of the bailouts from 2008 that we thought would never happen again. Another is 10% inflation. I'm sorry, when your target's 2% and inflation hits 10%, then all you got to say about it is shock, shock, shocks. That's not good enough. And the Fed does have a bit of a bring up the drawbridges, keep the barbarians at the gates attitude toward this, and has not really said, here's what went wrong and here's how we'll stop this from happening again. The Silicon Valley bank failure, though small, I think was very revealing. This was a set of bank failures where the banks had simply bought long-term treasuries, issued large uninsured deposits, and then interest rates went up and there was a run. So we have these hundreds, thousands of Dodd-Frank regulators and supervisors, and they're unable to see an elephant in the room here. That tells you something's fundamentally rotten in the way we, in our banking regulation supervision. And again, the Fed has not really said much about it other than we need another 100 rules. So there's issues, and I think it's worth thinking about how should the Fed be fixed with those issues. Now, more or less independence isn't obviously the question, and that's, I'm in favor of Fed independence. But what is it? Why do we want an independent Fed? What's the point of independence? Now, most people will say, well, to protect Fed decisions from politics. But politicians they'll hand out tax goodies and send people checks before elections. We don't put the Treasury as independent. So you got to have a better reason than that. The big one is pre-commitment. So monetary policy is, it's like Odysseus tying his hands to the mast. You want to commit yourself today to do things that you won't want to do tomorrow when the time comes, and that produces better policy. That's usually understood in terms of Nixon's famous jawboning of the Fed, hold the interest rates down, get me reelected. But that's, I think, not the issue going forward. And I think we need to face the really hard issue going forward. And that is the issue between Trump and the Fed. Now, why does Trump want lower interest rates? One of the big reasons is to hold down interest costs on the debt. The big pre-commitment issue of all of them is taxes and borrowing. We want to pre-commit that we will pay back our government debt, because then people will lend it to our government. Once the day comes, we want to inflate it away and not pay it back. So one of the big issues for Fed independence is to commit our government to pay back its debt rather than inflate it away. But independence alone doesn't really do that. If you look at the economic analysis of this, why should an independent Fed feel any differently about things than the government? That only works if you appoint hawks to the Fed, but nobody seems to like appointing hawks to the Fed now. Instead, the academic view of this, and I think is right, focuses on the limits of the mandate. We do not put our faith in the Fed is totally independent. Here, Chris, you're the new Fed chair. You win the sweepstakes. You get to run the Fed, print money, do what you think is right with it. We can't fire you because you're independent. That's not the way it works, right? The structure of the Fed has independence, but within a constrained mandate. The Fed, let's start with inflation and employment, which means, and nothing else. If you decide you want to reshore American manufacturing or fix climate change, you're not allowed to do that. Only inflation and employment. You're stuck in that limited mandate, which when you think about it is kind of strange. What's the easiest way to start inflation? Send people money. Fed's not allowed to do it. What's the easiest way to stop inflation? Take people's money. Fed's not allowed to do it. That's the Treasury. In a democracy, an independent agency has to stay within very limited boundaries, and it can't do a lot of things that it would want to do. So as I look at the problems, I think what we need is not so much more or less independence. Central banks can be too independent. There are other central banks around the world who go off on whatever they want to do and ignore the corrective feature of one person's political influence is another person's democratic accountability. And I think as Art and Gary pointed out, our Fed is not totally independent. And you get reappointed and you show up to Congress. So we're about right on that. But I think the mandate needs strengthening and better thought. Last thought on this. Going forwards, the issue for the Fed is going to be, well, financial regulation is a big one. But the other one, it's not going to be so much the Phillips curve. It's going to be fiscal pressure. And I think Gary brought up the deficit problem. In 2020, the Fed went along and bought $3 trillion of treasuries, practically the entire new issue. We monetized debt like it was Germany after World War I, and we were surprised that we got inflation out of it. In the next big fiscal crisis, should the Fed say, no, we don't want inflation here, you, the government, are going to have to face rising interest rates, or maybe you're going to have to cut things in a crisis, no inflation? Or do we want the Fed, can the Fed resist that and not have inflation? Should the Fed resist that and not have inflation? That's going to be our issue going forward, and it's not an easy one.
So there's a lot to unpack there and things. So I guess I'll start with you, Art. But one of the things that, well, all of you were talking, if there's this word independence, but there's also word accountability, and they're used interchangeably. So I'm just, in your remarks, if you could address this issue about independence versus, I don't know if it's a versus, but independence and accountability. Art?
Well, they're fuzzy terms in many ways, but as I said, we can point to, in terms of accountability, the fact that Congress really at any time could call the Fed in and testify and ask them, why are you doing what you're doing? And we could have a good discussion, I think, about banking panics and fiscal crises, and when the Fed should come in. And some of us would argue the fact that they did come in at the time they did during COVID, we avoided a very, very serious recession. And but we did put a lot of money into the system. We did buy a lot of government bonds. We're trying to undo that now. And I would say, and the counterfactual is always difficult, but I would say it was successful, but that's debatable. I mean, that's part of the economic science, like most science, is not perfect, and so we don't know. And so, in terms of independence, that we have this independence to make these decisions as a committee, based on the information we have. I think that's a very powerful part of the Federal Reserve, and why the Federal Reserve exists. Is it too independent? Who should be making these decisions? Again, I'll point to the fact that over all the years after 50, 70, 80 years, what after World War II, on average, the Fed has done a pretty good job. Again, I would agree with John. There are times when I was a little uncomfortable with some of these decisions, but overall, it looks pretty good. Gary pointed out the fiscal problems that our government is facing down the road, and John raises the question: how independent are we going to be? Are we going to be able to continue to tell the Treasury that they've got to figure out a way to raise taxes or cut spending? I think, and I give Paul Volcker a lot of credit for this, he has made it clear to the markets that we have a credible long-term commitment to keep inflation low. I think in that sense, we have, to a great extent, solved this problem of consistency. And I think the market is very confident in the Fed that, yeah, there's going to be movements in the price level, sometimes one-time movements, sometimes due to fiscal policy. But long-term, we're going to keep inflation low. And I think that is what we mean by independence and credibility. And that's the strength of the Federal Reserve. Accountable, again, I think anytime Congress can call us in and ask why you're doing what you're doing, and they clearly can influence our procedure. We again, they set the goals, we implement, and we do it in a way that's independent of political situations. We do it based on the science. My view of it is that's the correct model to have for almost any government agency. And I think the Fed has shown, on average, again, John's right, we've made some mistakes, but on average, I think we've done a very good job. And I think the system is the correct system.
And Gary?
Let me just make a comment in response to an observation John made, and that has to do with the Fed's role in bank supervision and regulation, where I think there clearly is room for improvement. History kind of illustrates that with the financial crisis and then Silicon Valley episode, et cetera. And of course, I co-authored a book on the subject. I'll give it for a little advertisement here, Too Big to Fail: The Hazards of Bank Bailouts, which I wrote with a former colleague at the Minneapolis Fed. It's been disappointing to me that the Fed and the other regulators haven't done a better job in this arena. And it's a particular concern because I know that some of the private sector participants in the financial markets, some of the large banks and large broker dealers, et cetera, do a very good job of risk management. And I think they do a very good job basically because they have skin in the game. What do I mean by that? They and their clients potentially lose money if they don't monitor risk very well and in a very sophisticated way. And I think the bank regulators have to find a way that where they can either mimic that or where they can put in place incentives to diminish risk taking in parts of the private sector that where risk clearly is being mispriced. It's not impossible to improve that situation. It's something I think the Fed and the other regulators need to take a fresh look at and dedicate more resources to, because the track record just isn't that inspiring.
And I want to get to Kettle and John, your response. But John, I do want to just add another thing as you're responding. One of the things that struck me is before I looked at what's happening with Treasury inflation protected securities, and just looking at the 5-year, and basically what the market is saying is inflation is going to average 2.2% over the next 5 years. I mean, maybe it's 2.4 one day, 2.1 the next day, but it's been, that's what it's kind of been saying. So I find this very intriguing. I mean, everything that's going on and trying to fire Lisa Cook and all the things that are why we're having this conversation. And the market seems to be saying, the Fed has the credibility, or I don't know what it's saying, but it doesn't seem to be that concerned. Investors
Well,
don't.
let me start with that one. Bond markets never see it coming. They didn't see inflation coming in the 1970s. They didn't see inflation going away in the 1980s. They didn't see the inflation of 2021 coming. Inflation's kind of a run-like mechanism. If you knew it would happen tomorrow, it would have already happened today. So don't count on bond markets seeing it ahead of time and giving you warning. Independence is, as we pointed out, the Fed has independence of method, but not independence of goal. Congress sets the goals, but the Fed sets the methods. Why? In part, that's our lack of knowledge of how things work. You need some discretion. You cannot reduce monetary policy to a rule. If you could reduce it to 4% money growth, Milton Friedman, or a gold standard, then you wouldn't need independence. You just, execute the rule. But every time is different, especially financial crises. It needs human intervention, and that's why you need to have that independent decision-making ability. But back to how we're a little bit of trouble. What the Fed right now, there's two big things I think I see. One is on containing inflation, which is still 3%. What exactly is the Fed going to do? We talk about managing expectations and so forth, but Gary talked about the Fed's reputation and so forth. But if your reputation is under threat, you can't just talk about how I need more reputation. You got to talk about what you'd actually do. And so the Fed's willingness to repeat 1980, if that's what it takes, is not obvious from anybody's statements. You have to really promise that if things get out of hand, you'll be a hard ass about it. And the financial regulatory thing, I think we don't pay enough attention to, and I'll just mention a couple things that I'm upset about. The Fed squashed narrow banks and segregated accounts. These would have allowed large institutional investors to have uninsured deposits, totally risk-free, completely cure financial crises forever from that thing. And there's a sort of sense in which keep the profits of the big banks going was some of the motivation. I don't know if it was or not. I don't want to make accusations, but those are clearly mistakes that then blew up in Silicon Valley Bank. And the Fed is unwilling to right now there's a push to have even less capital. Big banks are leveraged 10 to 1. That's crazy. And when you think about it, why do we need regulators on bank balance sheets, which are the safest assets in the world, and no regulators for Tesla or SpaceX, which is like the riskiest assets in the world? Well, because it's all leveraged 10 to 1. So lots and lots of capital and lots less rules would really solve this. But banks don't want lots and lots of capital. And that's a disadvantage of an independent institution. An independent institution is also timid. Because why upset the big banks who are making a lot of money on this and know they'll get a bailout next time around? It takes elected officials to say, no, I'm going to really stir up the pot here. You don't count on, the Fed is like every other administrative agency. You get bigger and bigger and bigger, but you also get more and more timid and don't want to rock the boat. And in financial regulation especially, it's time to rock that boat.
So what? Gary?
No, I didn't have anything, Chris.
So why don't I go to Kettle? You had a question that you wanted to ask?
Yeah. So John, you were describing how the Fed over time expanded its set of tools and perhaps made and its set of actions. Now, is your view that the Fed over time has abused its independence? And if so, what should be done about it?
Yes, well, I think it has expanded, but it's Congress's job to complain. And so I have this old-fashioned view that Congress should do things that Congress is supposed to do. Congress should set the mandate, and it should be clear about it. Congress said price stability. And the Fed said, oh, I guess that means 2% inflation forever. And anytime we screw up, we just let it happen and don't bring the prices back. Well, maybe that's what Congress meant when it said price stability. Maybe it's not what Congress meant when it said price stability. But when Congress acquiesces, then that perpetual inflation bias remains. So I would like to see Congress step up and be much clearer about the mandates and a little bit harsher on calling the Fed accountable to its mandates.
One of the questions from the audience wanted to direct to you, Gary, just because of your background and experience. Treasury Secretary Scott Bessent has expressed support for the idea that the Federal Reserve Bank presidents should be subject to a residency requirement. They have to live in their district. I think the number that's been around 3 years before their appointment. And what do you think of this? It's right in the news.
You know, I guess I'm not sure. This goes back to what's broken that you're trying to fix. I'm not sure what that accomplishes. I think it's important to bear in mind that in a way that problem is already solved. How? Well, the boards of directors of the individual districts that name the president are all residents and of the district and carry out whatever, whether they're bankers, agricultural people, manufacturers, logistics. Their businesses are located in that district. Some of them are in public policy as well. Anyway, you've got 9 people on the boards of the reserve banks. They're all from the district. And it seems to me that they are perfectly capable of identifying candidates who will represent the district to the extent that that's part of the concern they have in selecting a candidate. And I think that system has worked fine. And I think if you're a Reserve Bank president, and I was one for a long time, you know, you have a lot of interest, a lot of commitment to understanding the economy of the district and the concerns of the residents of the district, and so on and so forth. So, you know, that suggestion strikes me as, you know, that issue is already addressed.
You can live in a district for 3 years and not know anybody, and you can live in not live in a district for 3 years and know a lot of people.
Right.
This is a tendency to just
Right.
add rules on top of rules on top of rules without thinking about how much better monetary policy do we get. There's also a proposal out there that they should be democratically elected, not elected from the business community. And I hate to think, I love our president, Mary Daly in San Francisco. Can you imagine what Gavin Newsom would appoint as head of the Federal Reserve Bank of San Francisco? You know, that's a terrible idea.
Yeah.
And so, Art, I'm kind of curious. I mean, so the Fed's formed in 1913, and then in 1951, there's this Treasury Accord. So how was monetary policy as the Fed became independent and more independent? Did monetary policy improve without hurting economic growth, or did it improve economic growth? I mean, what's the difference when the Treasury was dominant versus when the Fed had its independence?
Well, potentially that's very important, because if we're just simply required to keep interest rates low to help finance the government deficit, that leads to significant concern about inflation today and inflation tomorrow. So that was a watershed in some ways. We got out of that accord and say, no, we're not going to be simply financing government debt, and we are going to manage the money supply, or at least our balance sheet, which we'll call high-powered money, in a way that long term we're going to try to convince the market that we will provide low inflation. And again, I'll go back to Paul Volcker. I think he made it clear that we're willing, you know, to let interest rates go pretty high sometimes in order to keep inflation down. And there's also some confusion about one-time movement in prices, which the media always talks about as inflation, versus ongoing increases in prices. And so you can have real effects going on. For example, some of us would argue that as we're seeing this high cost of medical care going up, that's not the Fed producing too much inflation. That's the fact that we got an aging population that's demanding a lot of health care. And of course, the market's going to respond by allocating those resources in a way that means higher prices. And those are generally one-time increase in prices. That's not long-term inflation. So I would argue that, yeah, I'm not saying the markets always get, you know, their forecasts of inflation right, especially when they're one-time movements in price levels. But generally speaking, the Fed has the credibility today, and a good part of it is because we told the Treasury no more. We are not going to simply keep interest rates low to help fund budget deficits. We are going to manage the money supply. So inflation is low, and some of us would argue, and in the low inflation environment is the way to promote long-term employment growth. Short-term, a lot of things affect short-term employment and unemployment, but long-term, stable monetary systems are very consistent with economic growth. And in many ways, I think Milton Friedman was right in trying to design a rule that keeps inflation low. However, when there's a national crisis, a financial crisis, or COVID or something, the Fed needs to inject money into the system for a period of time. But generally speaking, commitment, long-term commitment to low inflation, that's where business does the best, where there's much less uncertainty, reduce uncertainty for markets. And I think it started with Paul Volcker in many ways. And I think we at the Federal Reserve have gained a lot of credibility because of that particular period in Volcker's leadership.
Can I follow up on that?
Yeah,
There's incredibly basic point here that we all need to remember. Don't confuse relative prices, one thing versus another, and the overall price level. When people talk about inflation, they say energy went up, food went up, hospitals. No, it's not about, those are one thing versus another. The overall price level is always monetary and fiscal policy. Don't confuse those. And don't confuse the rate of inflation with the level of prices. And this goes both ways. That we had a big spurt of inflation. Prices are now 20% higher than they used to be. A lot of people say, oh, inflation's over. And the peasants with pitchforks, what's wrong with them? Well, the peasants with pitchforks see the prices are still 20% higher than they used to be. Those are just conceptually different. But 1951, it's not so easy. When you're fighting World War II, you don't want to lose World War II on the altar of no inflation. And there's an exception. And then there's always a, well, is this the exception or is this not the exception? The pressure on the Fed, if a new event happens and Uncle Sam wants to borrow another $5 trillion and something terrible happened around the world, the pressure on the Fed to accommodate that is going to be very, very strong. And 1941 to 1951 monetary policy happened for a reason. Huge debt. Government really wanted to hold down the interest costs on the debt. That pressure is going to be very strong, and really Congress has to decide. We want the Fed to really not inflate, and I think it would be much better if they had a strong anti-inflation mandate, and then Congress says, oh, it's an emergency, go ahead and print money because we got to win World War II again.
And okay, I have to say that sounds a little bit like a fantasy, but in the current environment, but we can always hope.
No, Congress passed the TARP. There's an example. Congress said it's an emergency. Yes. You can do stuff you're not allowed to do. Yeah. And if we give up on Congress, we might as well move to Russia or something.
Right. So this question from the audience is for you, Gary and Art. What do you consider the most surprising development in Federal Reserve policy over the past 15 years?
Past how many years?
15 years. You can go for 20. It's okay.
I have an answer too when you get there.
Okay, good.
Well, there obviously were a variety of one-offs if you go back over the last 15 or 20 years, some having to do with the financial crisis from 2007 to 9, and secondly to the response to the pandemic. Those, I guess I would describe as surprising, but not, I wouldn't necessarily say inappropriate. I think John's point about the Fed entering into areas that they previously hadn't occupied is worth pondering and perhaps ought not be repeated, but that's worth a discussion. Beyond that, I guess what I would point to is there was a fair amount of criticism of the Federal Reserve following the end of the financial crisis that policy was not stimulative enough, and therefore the ensuing recovery from the financial crisis was too tepid. It could have been better, and so on and so forth. Well, first of all, I'm not sure that economic research provides much support for that assertion. That's number one. And number two, the performance of the economy coming out of that wasn't all that bad. So while that may be one of the criticisms of the Fed, maybe the most telling criticism from my point of view in the last 15 years, I personally don't find it very compelling.
Art?
Yeah, well, what surprises me today is how much attention over the last 10, 15 years the Federal Reserve is getting in the media. The Fed is an important institution. I'm not saying it's not, but there's so many things that influence the economy, international events, financial problems, weather, innovation, AI. And I'm amazed at how much attention the Fed gets in the media almost daily. And this has been going on for a while, and it has surprised me. I don't think you'd see this kind of attention back in the 60s. And even during the inflation in the early 70s, or the stagflation, I don't think the Fed was getting this kind of prominent attention. And that has surprised me. I think it's in many ways misplaced. I think the short run, the Fed can't do much. The Fed can do great things long run, establish a stable financial system. But all this attention to tweaking the economy that the Fed might be able to do, I think is overstated. If the Fed could really end in recessions, had a button they could push, we would have pushed it a long time ago. In fact, I would argue business cycles are part of a market economy. And to try to predict the next month or next quarter where the economy is going or where prices are going, I think way too much attention to that. I don't know what to do about that, but I think economically that is the wrong way to think about our economy.
And John?
This is great. We spend way too much attention on the Fed. We're all drunks who look for our car keys where the light is because that's what we know how to do. But the car keys are over there. You want employment, that's about education, tax distortion, social programs. The overnight federal funds rate is like the last thing to worry about with employment. Right. You want growth that comes from innovation, AI. Can you get the permits? That's not about the Fed. But the Fed can screw up, and the background of stable money, stable financial system, that's important. But the other stuff matters. You said what surprised me. I want to say good things about the Fed. Starting in 2009, we went to paying interest on reserves. We went to a huge balance sheet. There used to be 50 billion of reserves that went to 4,000 billion reserves, and you would think that enormous, and we went to pegged interest rates. The interest rate just sat there for 8 years, 30 years in Japan. If you woke up if you lived before 2007, you would say, I don't know what'll happen with all that. You probably get hyperinflation or spiraling deflation, a pegged interest rate at zero, huge balance sheet, interest on reserves. Who knows what'll happen? What we learned is nothing. That's about the most benign scenario you can imagine. I think nobody would have predicted nothing, but that opens the door to really a wonderful new future. We don't have to restrain liquidity. We can live the Friedman rule of awash in liquidity, interest on reserves. I think that's just wonderful. Lots of people still hate it, but I think we should accept the evidence that inflation went nowhere during these periods.
Cool.
Oh, the other thing we learned, of course, the slow recovery. I agree. The slow recovery was supply. It takes a while for people to find new jobs and find new businesses. And throughout that 10 years, there was secular stagnation, modern monetary theory, overwhelming demand for U.S. government debt. All you need to do is borrow money, throw it out the window, and Keynesian stimulus will all get rich. What happened? We finally borrowed money, threw it out the window. What do we get? 10% inflation. So we learned something else very important there: supply.
So I want to get to some more audience questions here, and this might go for you or Gary or Art. The summary of economic projections often shows a dispersion of views among FOMC members. How should the public interpret that dispersion? As healthy diversity or as uncertainty about the policy path?
Both. It's both. I mean, well, it is because it would be surprising if, given all the participants, all the principals in an FOMC meeting, if there was coalescence all the time around one forecast. I mean, that would be surprising, and probably not healthy, but certainly surprising. Does it also demonstrate uncertainty about the policy path? Well, of course. It's decision making under uncertainty. That's really what the game is all about. And as I commented in my first remarks, forecasting the economy, the U.S. economy or any other economy is going to be fraught with error, especially if you're trying to get it within a fairly narrow bound and within some kind of relatively short time frame. It might be relatively easy to say, well, the U.S. economy is going to grow at X% over the next few years. You look at demographics, labor force participation, put in some productivity guess, and you've got a number. But what the economy is going to do over the next several quarters or the next several years is a much more challenging task, and one that people ought to approach with a lot of humility. So there's always uncertainty. And I think the dispersion of those projections is therefore both healthy and understandable.
So this question is go ahead.
I just wanted to ask, I have an honest question on this issue. Are we not disclosing too much? Is it really helpful to have this dot plot of every individual's forecast? If I went into a tenure meeting and each of us had to put up a dot plot of how many papers the candidate's going to make over the next 5 years, that would be embarrassing, stupid, and not very useful. There is a view, less cacophony, less airing out our dirty laundry. Let's just, make a decision and get to it. Similarly, why are we talking about forecasts anyway? The forecasts are terrible. Look at what happened in the inflationary period, where the forecast was always AR1 back to 2%. This notion of we're going to really talk about our forecasts and then tell you what we're going to do because we think that forecast is going to be real. You mentioned data dependent before. I think it's much, if you want people to have insurance about what you're going to do, saying we know the future and here's where we're going to go is a terrible idea. Saying instead, if inflation comes out more, we're going to ram up interest rates. If it comes out less, we're going to go down. Now you know what we're going to do. Let's wait and see what happens.
I personally, I agree with all of that, John. I think, I tell people, there's a lot of Federal Reserve people speaking all the time. You ought to pay attention to what the chair says and pretty well ignore what the rest of the guys have to say in public. That's number one, unless you happen to just have a lot of time on your hands and want to follow all of this. The other thing I would say about it is, the Fed can't escape forecasting, but I agree with you that we ought to handle those. We ought to handle all of that with care, and I'm not sure it's adding a lot of value the way it's being produced right now.
Is there a problem that they feel the need to give speeches to get through to the chair, as opposed to why don't we get together and talk it through privately, quietly?
Yeah, I think some people are frustrated that they're not heard at the meeting. I guess I would say depends on the quality of your argument, and if the quality of your argument isn't that good, you shouldn't have high hopes that the other members of the committee are going to pay a lot of attention.
So, Art, I want to direct this question to you.
Wait, before you get into that, I just wanted to add to this. And here's where I think Milton Friedman had it right. We've known for many years about the uncertainty in forecasting. Most of the considered the best models weren't stable over time. A lot of research to show the standard errors of forecasts are huge. And that tells you what the Fed should be doing is just follow a steady rule. They shouldn't be adding to the uncertainty. They should be minimizing the uncertainty. And so that's why, again, I go back to Paul Volcker, who said the basic goal is to keep inflation low. We'll do the best job we can. To try to anticipate every wiggle in the economy and react to it, I would argue is the wrong way to think about monetary policy. Stick to a rule. When you have a crisis, then you may want to look at something. But otherwise, I think Milton had it right.
So let me direct this one to you, Art, which is as a small business owner, I want the goals of Congress and the Fed to represent me. How do we shift the goals to support small business more than at least as much as big? They seem to be favoring big business.
It's not my take on it. I think the Fed tries to, again, keep inflation low is good for all business. To reduce uncertainty in the economy is good for all businesses, small or big. Let me say something about small businesses. The successful small businesses eventually grow into big businesses. And so I think, to the extent that the Fed has a tool that it can influence the economy, it's basically a tool that again, keeping inflation low is good for all business. I've never even heard that discussion at any FOMC meeting, trying to distinguish between whether our rules should favor one or the other. I think that's a non-starter.
And this is a good question here. It's came up in some of the remarks. How much of the 2021 inflation increase and ongoing inflation was due to significant increase in money supply in 2020? Who would like to take that?
Well, I've written papers about this, and no, there was a huge increase in money supply, but it was to finance a deficit. There was the same increase in money supply, monetary base, during quantitative easing, which was used to not finance a deficit, had no effect on inflation at all. So I think it is the monetary financing of deficits that did it, not the money supply per se.
Okay. And then last, we're reaching sort of the end of our meeting. So I'd like to give everyone the opportunity just to give, what is your parting thought? What is the takeaway that you want? You have about 30, 40 seconds each. What is your parting thought you want people to think about as, this webinar ends and, we go on and do our other things? What's the thing you want what's the takeaway you want people to think about? And I'll start with you, John.
Oh gosh, I needed a few minutes.
Always got to start with somebody. Sorry.
Things are less certain than you think, but stable, well-run institutions are really important. And that's really where people gain their faith about things, which involves be simple. I think there's this pretense of technocratic ability to manage some huge thing, especially you see that in financial regulation. Simple and transparent is going to give much more better results and more trust.
Gary?
I'm going to build on something Art said earlier. I think we all ought to bear in mind that the U.S. economy is a very large, complex, sophisticated, resilient, flexible economy. Yes, Federal Reserve policy can influence it on the margin, but there are lots of other things that are going to determine how the U.S. economy performs over time. I think we need to bear that in mind. I think the Fed's principal responsibility is low inflation. I think that goes hand in hand with high employment over time, and we shouldn't get too worked up about what's going to happen at the next FOMC meeting, et cetera.
Art?
I'll go back to the original theme of this webinar, and independence is critical. Is critical for the Federal Reserve to do what's able to do, and so I get worried when that is threatened. And it's always threatened to some degree. There's always going to be some political person that's unhappy with what's happening in their district, and they're going to use the Fed to blame them and blame the Fed. So independence, in my mind, is critical here. And I wanted to get a better understanding of why the Fed was created, why it was created independent, and have the public have a better understanding of this issue. That to me is the critical takeaway I'd like to have from this webinar.
That's right.
Now, well, thank you very much. I could keep going, but there's the tyranny of the clock. So I'm now going to turn things back over to Jettel.
Thank you very much for all your efforts and for the discussion. I encourage you, the listeners, to visit the Heller-Hurwicz Economic Institute website for more economic research and policy briefs, including links to episodes of our excellent podcast, Office Hours. This webinar recording will be made available as a special episode of that podcast, so watch for that. Thank you all for being here and for the excellent discussion.
Yeah, thank you very much. Really appreciate it.